Steve, great to see you again, buddy. Appreciate you joining us. I mean, listen, you've been bullish through this all. Even pre-COVID, I remember having you on set when you could do those kind of things. And you remained optimistic as the market remained volatile. You've been right. So congratulations on that to you and your clients. Do you remain optimistic at these record highs?
We do. I think the biggest story that's in the market right now is that we are exiting recession and entering recovery. That's a very powerful driver when you think about the business cycle and its effect on markets. Now, there are some things we need to get through, right? You certainly have the stimulus uncertainty. I'd love to have, something on the vaccine front, but I do think that's forthcoming. But you don't want to have that economic momentum that we've built over the last few months here, and it seems like it's reaccelerated really in later part of July and early August. You don't want to see that kind of be wasted by a lack of that additional fiscal support that's needed. So it'd be really encouraging that if when Congress decides to come back to Washington, maybe they address this issue. Baffling to me that they recessed in the first place.
And where are you seeing value in the markets right now, Steve, domestically, internationally, if anywhere, given some of these heightened valuations?
Well, look, historically, small caps do about 25% better than large caps do in the first year following a recession bottom. So that's an area that absolutely has our focus. I think secondly, and you very rarely hear me say this, but I think international looks better than it had. Europe seems to have a little bit more fiscal cohesion. Their virus data is a little bit better. And its value. Again, in those early stages of an economic recovery, the value names that get hit hardest on the way down recover, at least the ones that are going to survive. And when you look at the international indices, particularly in Europe, there's a lot more value there, whereas the U.S. indices are much more growth. And so not that growth is going to roll over and die, but we think that value can recover here a bit off of some depressed levels.
It's amazing because obviously you may have heard about this pandemic that we're going through, Steve, and COVID. Eventually that will end. In fact, we've got some news on that coming up later in the show. Longer term, do you think America's fraught relationship with China will be the single biggest investing story for years or maybe decades to come? And that was me texting you just saying thanks for coming on the show.
Thank you. In terms of the U.S.-China dynamic, Brian, I think this is a huge issue. You've got two countries that are fighting over the technologies that are driving an industrial revolution. And while the tensions have certainly been disruptive to economics in the market, I think one of the things you need to not lose sight of is that a stock is the value of its future cash flows discounted back. If our companies are able to maintain their intellectual capital, they're going to be worth more than if they give away that intellectual capital. So, look, I think it's going to be a key issue for a number of years. I think the United States has two real strategic advantages, though. One, we still have population growth, while China and a lot of the rest of the world are in population decline. And two, we remain the center of innovation. And as long as those two kind of underlying conditions are in place, I think the United States is well positioned to continue to be the world's strongest economy. But I think that tension is going to last for quite a while.
Yeah, certainly will. So how do you invest around it? I mean, do you buy some puts as protection? Is there something you can do to maybe, hedge it? Because you don't know when you wake up every morning what the headlines might be.
I think there's two things. I think number one, right, you want to be able to invest in this idea of companies coming back to the United States or investing in the United States because we have cheaper energy, faster shipping routes, better intellectual property protection, one of the lowest tax rates in the world. I think that's an advantage. And I think it also helps small caps that'll be a part of this revamped supply chain. And then I think secondly, when you're investing in emerging markets, a lot of times when you do a broad index or an ETF, that really is a China story. Well, maybe you don't want to do that. Maybe you want to be a little bit more selective and be able to choose which countries within emerging markets you like better or worse. Maybe you want to be more invested in countries like Mexico and India and not just have that broad index that is dominated by China. So those are two ways that we would do it. Focus on the U.S., focus on small companies, and be selective in EM.